Debt market update. GSEC yields remained largely range-bound during October 2022, and 10Y GSEC yield ended 5 basis points higher at 7.45%. However, the short-end yield rose significantly more on the back of tightening liquidity conditions. The movement in yields was driven by rise in domestic inflation, robust economic growth, relatively dovish monetary policy committee minutes, higher US yields, and uncertainty around terminal rate of US Fed fund rate, etc. Corporate bond spreads over GSEC narrowed slightly as the lower supply kept the corporate bond yields capped. Average net interbank liquidity declined sharply month on month, driven primarily by US dollar sales by RBI. Further, the credit growth outpaced deposit growth, which also weighed on the liquidity. FPI's market activities continued to remain muted, and they were net sellers of debt worth $0.3 billion in October 2022, as against net buyer of $0.3 billion a month ago. Cumulatively, FPI's flows have been flat during 7MFY23, vis-a-vis being net buyers of $4.2 billion during the same period last year. Outlook: rates not too far from peak. The MPC minutes for September 2022 meeting were relatively dovish compared to market expectations, with rising divergence between the internal and external members of the committee. Two of the external members of MPC hinted that in their view, current policy rates are close to terminal rate and advocated wait-and-watch approach given the monetary policy impacts with a lag, while governor and deputy governor statements indicate the need to continue hiking given the global monetary policy tightening. In view of the above, while RBI might continue to hike rates in near term, the current market consensus is incremental rate hikes in the range of approximately 60 to 85 basis points only, that is, terminal rate of 6.5 to 6.75%. Over the past few months, the Indian 10Y GSEC yield has shown significant resilience despite the rise in global bond yields, increase in domestic policy rates, and external sector risk continuing to weigh on the outlook. Going forward, conflicting forces are at play in the near term. Elevated inflation and inflation expectations, steady domestic growth momentum, and continued global monetary tightening are likely to put upward pressure on yields. Additional inflationary pressures could emerge from currency depreciation and persistently high WPI trickling down into CPI over time. Moreover, heightened geopolitical risks and depleting foreign exchange reserves are also likely to be important considerations going forward for domestic policy rates and thus yields. Also, supply of state development loans (SDL) is likely to increase in second half as the spending picks up. This, along with high SLR holdings of banks and robust credit demand, could put further pressure on yields. On the flip side, broad-based correction in international commodity prices and easing supply chain constraints should ease inflationary pressures. Further, expectations of global growth slowing considerably in next year can result in global central banks pausing. Low risk of fiscal slippages also bodes well for yields. Moreover, expectations of RBI being not far from terminal rate is likely to keep a lid on yields. Notably, tight liquidity and strong credit growth can put higher pressure on yields at short end. On an overall basis, given the counterbalancing forces at play, yields are likely to trade in a range with an upward bias in our view. In view of above, we recommend staggered investments into short to medium duration debt funds, with some allocation to longer duration debt funds in line with individual risk appetite. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.